Hello and welcome to this week's episode for Conservative ETF Investor. This is the stock market update for March 1st, 2025. I am your host. My name is Ken, Senior Market Analyst for Conservative ETF Investor. We currently have a yellow for the stock market strength color signal. And with this strategy that I'm going to go over in this video, last year we returned 37.29%, smoking the buy and hold investor by 14%. Here on this channel at Conservative ETF Investor, we want to beat the market. What that means exactly is we want to beat the returns of the S&P 500 buy and hold investor. And we have two goals that we're trying to achieve. Number one, we want to beat the benchmark, in this case, the S&P 500, and we use the ETF SPY, referred to as spiders, as what we're referring to when we talk about the market, the S&P, spiders, all that's all the same. It's all the S&P 500. All right, we want to beat it by more than 5% on an annualized basis. And number two, we want to make at least 20% annually. If we can accomplish those two goals, and by the way, those two goals are very difficult to achieve. Over here, just doing a regular Google search, how many people can beat the market? 89% of fund managers fail to beat the market. As a whole, somewhere between 78 and 97% of actively managed stock funds failed to beat the indexes. So you can see how challenging it is. And that's why most people just say, the hell with this. You have to be a buy and hold investor. You have to just stick with the market through the good times and the bad, and you have to ride out the storms or the bear markets. You just have to stay fully invested. The way that Wall Street wants you to work, or invest, I should say, is they want you to be simply fully invested at all times, always on buy mode, up until the day you retire, and then you start doing your 4% annualized withdrawals or something of this nature. This is how Wall Street and the like want you to operate. And for most people, that actually works. So approximately, let's just round this out and say that there's about 88% of investors cannot beat the buy and hold strategy. That leaves about 12% of investors that can beat the buy and hold strategy. I am trying to be one of those 12% investors. We did that last year in 2024. We're going to try to do it this year in 2025. There's no guarantees because it's the future, it's an unknown variable, and I don't have a crystal ball, and neither does anybody else for that matter. But if you want to stay tuned, stick to this channel, subscribe to my channel, watch me as I produce one video per week, and I put out that video, we talk about the market, and we talk about how I am trying to beat the returns of the S&P 500 buy and hold investor, and I'll show you that throughout the videos. And just by watching these YouTube videos, you will see what my strategy is all about. But basically, it's just riding the waves, but we'll go through that when we really look at the charts. So I'm just trying to explain to you why you want to be watching this channel. On today's video, we are going to go over all this video content. This is a full month-end review content. This video is longer than my intra-month videos, where I try to keep them short and sweet. Although I do seem to blab a lot anyways, I want to try to make everything as short because your time is valuable, my time is valuable. So let's get into today's video right now. All right, here are some past returns for our strategy. So in 2024, we smoked the buy and hold investor by 14%. But in 2023, we did not. In 2023, we did 14%. I was way too conservative while the market did 24%. I underperformed by 10% in 2023. I had a great equity curve, meaning we didn't really have any drawdowns, but I in retrospect, looking back, doing an analysis of the trades and how I traded the market that year, that was too conservative. In 2022, we did really good. In 2022, the S&P 500 returned a negative 19%, and we were positive 21%. That's a 40% differential. So even though we didn't quite do so well in 2023, in 2022, we more than made up for it. All right, so what happened last week? The S&P 500 lost 0.96%. After all that turmoil, if you guys watch the market like I do, there was a lot of turmoil last week. Only down 0.96% for the week. Now, the NASDAQ 100, or the cubes that we refer to it as for the ETF, down 3.4%. The cubes, that's technology, okay? Technology is basically where things are at. The technology index has generally been outperforming everybody else because technology is basically where it's at. We're starting to see technology get hit hard. Now, we don't know if this is going to continue, and if it is, well, then that's going to be the hardest hit on the way down. So we always watch the markets, but we want to see how well everything plays out. Now, small caps, they were down 1.45%, so somewhere in the middle of the large cap and the technology stocks. All right, now I do manage and send out 4 portfolios, the S&P 500, the NASDAQ 100, small caps, and I have a small account with a small balance of $3,450, and I trade that account, and I give anybody that signs up for my real-time trade alerts, there will be a link for it in the description down below. Now, I want to share with you guys the SPY portfolio. I sent out 1 trade alert to my subscribers for the SPY portfolio last week. On Wednesday, February 26th, approximately 12:33 p.m. is when the announcement was sent out. And I send that out in 2 different ways. I send it out with a text alert and through email. Now, in the SPY portfolio, we're going to buy to open 2 long calls contracts, expiration 12/31/25. It gives us till the end of the year with a strike of $6.50, and the cost per share at that time was $14.21 per share. We did 200 shares or 2 contracts, so that totals $2,842. Okay, so with this strategy, as I mentioned earlier, we did beat the S&P 500 in 2024 by 14 percentage points. We were 37.29% for the year. The buy and hold investor for the S&P 500 was 23.3%. If you want to sign up to receive real-time trade alerts, you can do so at this link right here. It will be down in the description down below. I have 3 pricing plans. You can choose the silver month-to-month membership plan or the annualized gold plan billed once per year. Or if you just want to support the channel and support the work that I do, you can do a one-time payment with the Patreon link right there at $25. All right, now we are looking at a 10-day candlestick chart for the S&P 500. And in these last 5 days that are right here, you can see last week's action. On Wednesday, the 26th of February, that is the day on this candle right here that we put out our alert that we're going to buy 2 long calls. What was happening? Well, I was already long the market, 200 shares right here as of the 20th. Then the market tanked. Instead of going up like I thought it was going to do, it decided to go down. And then it continued to go down. But then I saw it going sideways, and I thought, now's a good time. Let's go ahead and start buying some leverage. So what I refer to as leverage is these long call options. Now, we can buy long calls, we can sell calls, we can buy puts, we can sell puts, as well as shares of the ETF SPY in the model portfolio, in the SPY model portfolio. So in this particular case, I thought that we were reaching a bottom, getting close to a bottom, and that we were in an oversold condition and a bounce was coming. The market the very next day on the 27th said nope and decided to go down a little bit further. But the day after that says, you know what? This is the bottom, or supposed bottom, and now we're going to start bouncing up. So here we are right now, at 594.18. We need to see what's going to happen on Monday. I'm thinking that we are in an oversold condition and we're going to start to go up. I have a lot of lines on the chart. Let me delete. So I'm thinking that we're going to start going up from here. Only time will tell. We'll see what the market gives us on Monday. Now, next week, I actually am anticipating sideways to upward action, but nothing too crazy. I'm not expecting a V bottom, down and then up. I don't think we're going to get that. I think we're going to go down, go sideways, and then up. All right, here are the trades that I've made in the SPY model portfolio for 2025. We are currently down for the year, negative 0.17%. The buy and hold investor for the year 2025 is up 1.38%. Yes, they're ahead of us. Yes, our goal here is to beat the S&P 500 buy and hold investor. We're not doing that. But now that we've got a lot of our portfolio, 92% invested in shares of the S&P 500, the yellow represents open positions. So on the 10th and on the 12th, I did buy 100 shares and then again another 100 shares. And here was the amount. This is the purchase price that we paid for those shares. We're currently negative in both of those transactions. And we're even negative in the transaction that I made on 2/26/25 by $425. We started the year off with $130,000. We're currently, the model portfolio is at $129,773.6. So we're down 0.17%. You could say we're flat for the year. We're very close. These numbers are within 2% of one another between where we are at right now and the buy and hold investor. If this market starts to bounce, that 92% is going to bounce with the market at 92% of our total portfolio value. In addition to that, we've got 200 shares or 2 contracts of some option leverage. If this market does start to go up, maybe I think what I'm going to end up doing is putting on another long call option to put some more leverage to work, because I think we're at a short-term bottom. I don't think the market is going to crater at this point. So that is where my head is at for my trading strategy. If you want to see how I do this week in and week out, I want you to smash that like button down, subscribe to my channel, and ring that bell. Now we are looking at an equity curve of our model portfolio in blue against the buy and hold investor in pink. Our whole goal is for our blue portfolio to be above the pink. I know it's not above the pink right now, but we're within 2 percentage points. We track this because we want to see how well we are doing. Now, as of, well, pretty much almost the whole year, I've been pretty closely tracking with the S&P 500. If this market gets a bounce, the S&P 500 is going to do something like that. And I'm hoping to do something like that, where I kind of come up and begin to overshoot the S&P 500 and then continue that strategy for the remainder of the year. Only time will tell. There's a lot of white space here between now and the end of the year. So we have a lot of work to do to keep up with this. There's the Fed chair, Jerome Powell. These are all the dates of the FOMC meetings in 2025. The next announcement is going to be on March 19th. On the announcement of March 19th, there is a 93% probability that they are going to keep the rates exactly where they are at right now. So in other words, it's going to be a hold. This is a chart of TNX, which is the 10-year U.S. Treasury yields. That is the candlestick chart. In dark blue, that's the S&P 500. There's dark blue right there. The black represents the ETF TLT, which is 20-year bonds. As TNX travels south, TLT travels north. Completely 180-degree opposite. So we want to keep an eye on exactly what we're seeing. What is happening? We were in this trading range. We broke out of it, and now we have now established a new trading range. The new trading range is between here and here, and we are in that trading range. and until we break out. So because we're now, it seems to be, we are in a new established trading range, I put down here for the symbol the bears and the bulls, indicating that the S&P 500 is going to be somewhat neutral with the position of TNX. See the blue, the S&P 500? So when the rates dropped, normally that's bullish for equities, but in this case, you can see the rates dropped, and during the same time frame, the S&P 500 dropped. Now you're starting to see a bounce on the S&P 500, but interestingly enough, when the rates dropped, instead of that being positive to the market had other ideas and it decided to travel south. Now we are looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500, which are over here, and for the NASDAQ 100, which are over here. So let's focus on the S&P 500. This is currently 2025, the year after the election, historically speaking, has produced an annualized return for the S&P 500 of 6.7%. Currently, the S&P buy and hold investor is up 1.38%. So if you take into account presidential election cycle theory, we are going to be bullish. That's why we have a bull symbol here, taking into account where we are at now and where we should be at the end of the year. We should, according to this theory, be positive, so this is a bullish indicator. Now, all the stuff that I'm going to show you, you're going to get cross currents. Some stuff is bullish, some stuff is bearish. At the end of it, we need to take the sum of the evidence to make our own conclusions as far as how we should be positioned at this time. Okay, now we are going to look at the bond market, and we need to pay attention to the bond market because the bond market is 3 times the size of the stock market. Now, we also want to look at the yields, the 3-month, 2-year, and 10-year yields. Now, the normal yield curve is when the 10-year is greater than the 2-year. So here you can see that the 10-year is 4.28 and the 2-year is 4.1. This number is higher than this number. That's a normal yield curve. So do we have an inverted yield curve? No, we do not. But do we have a rising interest rate? Yes, we do. Last year we were at 4.27. This year, 4.28 for the 10-year. But look at how close they are. Basically, you might as well say flat. But from a technical basis, it is rising from 4.27 to 4.28. As a matter of fact, everything is very, very tight. All the yields right now, the 3-month, the 2-year, the 10-year, usually you have a greater differential between these spreads, but right now this is just an incredibly tight bond market. So in this case, I put down the bear and the bull symbol, indicating that from this information, it's kind of neutral for the S&P 500. All right, there is the man, Mr. Warren Buffett, the Oracle of Omaha. This is CNN Business, Fear and Greed. We are in extreme greed. Be fearful when others are greedy, and be greedy when others are fearful. We are following Warren Buffett's advice. We are in extreme greed. We are in 200 shares in our model portfolio of SPY, and we're starting to tack on leverage. We've got 2 long call options right now in our portfolio. We can add to that. We still have cash in our portfolio to buy some more, but I don't want to do that until the market starts proving to me that it is worthy of that investment. I want it to go up. Then we'll add some more to take advantage of now a rising phase of the stock market. Okay, now we're going to look at seasonality. We just passed the month of February. We are now entering the month of March, but let's focus on February for a second. The month of February had a 40% chance of being positive or a 60% chance of being negative. What happened for the month? For the month of February, the S&P 500 was down 1.27%. following through with that 60% probability using 5 years of data on a seasonality basis. Now, let's put that in the past. Let's now look at the future. The future is March. Using 5 years of data, March has a 100% probability of closing higher than when it opened the month. It should be a profitable month. Will the month be topsy-turvy? Yes, but we've got pretty good odds in our favor going long this market. And as you know, I am long right now. Now, over here in our monthly candlestick chart, drawing a couple of trend lines. This one here for resistance, this one here for support. You'll notice that where we are at right now for the month of February, the month is closed. We closed right at that support level. Hopefully, that support level will hold and we bounce up like that and come and tag, like we have many times, the resistance level. Is that a guarantee? No, we have done it many times in the past, and I certainly hope we do it moving forward, but if it doesn't, it doesn't. The market is going to do whatever it wants to do. But I'm positioned to take advantage of the market during this rising phase with the way that we are invested right now. And I'm going to add to it. If we start going up, I'm going to put on another long call. And maybe I'll do that even a couple more times to take advantage of a rising phase in the market. This is the advantage of trading the market rather than just being buy and hold. Although we know it's very difficult to do, you have to be in that top 12% of investors to benefit from this. Now, continuing on with seasonality, using 10 years of data, month of March, 78% probability. Using 15 years of data, month of March, 79%. Pretty good odds that we're going to have a positive month. So I've got the bull symbol right there, bullish. Now, this is an historical annualized returns for the S&P 500 going all the way back into the 1930s. Now, I'm going to draw a line at the 20% mark right like that. Now, not the current year, 2025, 2024 and 2023, two back-to-back 20% years. Now, when you go back and you look at two back-to-back 20% years, what happened the year following that? Now, this was 1995 to 2000. This was the internet tech bubble right here. And looking back, this was really an incredible time for the market. That was the technology.com bubble that was produced during this 5-year time frame. But generally, that's a little bit of an anomaly. Going back, here's 2 years, very close to the 20%. The very next year, down. Going back, there's 2 years. The very next year, very small, 3% gains. Going back, looking for 2 years, the very next year, down about 35%. Massive down year. So we did have two back-to-back 20% years. Now we're in 2025. Currently, you're looking at a red stick on this chart right here. And if that continues, I don't want to get caught being down and being a buy and hold investor for 35% drop. So we definitely want to watch what is in store. It's the future. Nobody knows, but something to keep in mind. All right, now we are looking at the Spider's monthly chart. This is a line chart. We want to focus on the line that is in black and red. I have a whole bunch of exponential moving averages, and I refer to that as the ribbon. This chart goes back 20 years, tons of data in this chart. What can we ascertain by looking at this long 20-year monthly chart? We can say that we are in a bullish configuration. Why is that, Ken? No, there's a few reasons why. Number one, If you look at where we are at right now compared to the ribbon, we are completely above the ribbon. So that alone, and if you look at the way that the ribbon, look here in the thumbnail, look at the way the ribbon is fanned out. It is fanned out perfectly so that the faster moving average, which is the smallest number, is up here at the top, and the gold number, which is going to be your slowest moving average, in this case 24-month EMA, is down here at the bottom. So because this is fanned out the way that it is, and it's not producing what you could say is cross currents, like over here, notice how the ribbon twisted, and that's when we went completely down into a bear market with a twisted, flattened ribbon. That is not the case right now, and we are traveling above the complete ribbon. So from all this information, it's positive. There is a bit of concerning information in this chart. That is the MACD. The MACD is at the highest level it has ever been at in history for looking at SPY. The number is almost 50. It's at 49.26. You can see here in the thumbnail that we've reached a little bit of a flattening out. Over here on the slow stochastics, we are below the signal line, although it looks pretty parallel, but slightly below. But we are still above 80. When and if we cross below, the first thing that's going to happen here when this market starts going south on us, the first thing that's going to happen on this long-term monthly chart is that the slow stochastics is going to cross down below 80. That is going to be the 100% signal that basically this market is now entering into the downward bear market phase of long-term investing. So we want to monitor this. We monitor this every single month. When the month closes, we look at this, but the first thing that's going to happen is going to be the MACD. After the MACD goes down, then after that, you're going to start to see, after the slow stochastics goes down, the next thing is going to be the MACD that's going to follow it. If you look here at the histogram, you can see that the histogram on the MACD is losing energy. So we are at the highest level we have ever been at. So the last time that the MACD crossed below its signal line and went down from signal to signal, the market experienced a 25.1% correction. So are we going to watch this? You bet your bottom dollar we're going to watch this. And if indeed the market starts doing that, we're not going to be buying calls. We're going to be buying puts. We're going to be taking advantage of the market while it is traveling south. Okay, this is a weekly it's a 5-year duration, and it is a candlestick chart for the S&P 500. We did have a rising wedge pattern. We had a breakdown. I drew that with this blue line. Then I came down to a projection of where the market could fall with this breakdown, taking us to about 540. We are nowhere near that at 594, but it was a possible area that we still may hit in the future. Now, what's happening over here at the MACD? The MACD is not only below its signal line, you'll notice the distance between it and the signal line is increasing. That is bearish. Slow stochastics below 80, below its signal line, and clearly traveling south. Bearish. So we call the weekly chart an intermediate term time frame. So from this perspective, we are bearish on the market. Now we are looking at a daily candlestick chart for the S&P 500. What do you see in this chart? And we do have some cycle brackets down here at the bottom. What you do see is the slow stochastics has clearly reached a bottom and is above its signal line and getting ready to go above 20. We actually just reached 20.19. Well, that carries up like that. Look at the histogram on the MACD. You can see this bar is more shallow. See how shallow that bar is compared to this bar? You're starting to see energy go that way. That's going to bring the MACD up like that. Well, when all this happens, what do you think is happening to the S&P 500? It is traveling that way. Now, I did put down here a support line here, and you can see I carried that over across, and so here it was a resistance line. Then when it broke through, it acted as a support, acted as a support, acted as a support. Until it breaches and comes down, this is an absolute support line, and we did tag it, and it appears as if we are now going to be traveling north. We need follow through. This is just one day, folks. This is Friday's action. But it seems reasonable that we're going to come up and at least tag that number right there, which looks to be about 608, somewhere where this old high was made right around here. Let me just clean that up. Right there. So it seems that we should at least tag the 608 number. And at that point in time, it may continue to go up, but then the risks are going to be increased. Now, if indeed we do all of this that I'm suggesting, we're going to take some steps in an effort to profit off of the whole thing. Let me explain. Right now, where we are at right now, as of Friday's trading, you know that I've got 200 shares long SPY plus 2 long call options. If indeed this market starts to go up, maybe I'll put on 1 or 2 more calls. But once we start to come up to here, guess what I'm going to do? I'm taking that leverage off the table. We'll sell to close those long call options. We will profit because our long calls are going to be more profitable, that cash. Now we know that our long calls are going to go from a value of 594 to potentially 608. We'll leave that on the table for now, and we'll see what the market does. We'll see where, how the market is trading at that time. We may want to start putting on some protective positions, and we have a couple different ways that we can do that. We can take shares or money or shares right off the table and just put them in cash and sell them for profit, or we could do some in-the-money covered calls. We could buy straight out puts. We have options available to us on how we want to manage the portfolio. We're not there yet. We need to get there before we make those decisions. So we're going to watch that, and we'll see how the market treats us. Now we are looking at a ratio chart for the NASDAQ 100 against the S&P 500. That is the chart that is in black and red. I drew in here a support line taking into account that low and that low. So that's that support line. We dropped below that support line, and we appear to be now traveling sideways. So it's very possible that we are going to now come back up into above that support line, giving us an area to now continue to travel north. That would be what we refer to as a risk-on situation. Risk on means money in the market, putting money to work, putting money at risk. You are risk on as opposed to risk off, going in the opposite direction. I got down here the bullish symbol. What's happening on the slow stochastics? We have clearly bottomed. We are above the signal line and getting ready to go above 20, traveling north. The MACD is still heading south, but if the market and everything continues to travel north, if it maintains what it did on Friday, well then the MACD will follow thereafter. Now, this particular chart is a chart that I put a lot of interest into because I think this is going to be our bread and butter ticket moving forward. Let me explain. Ratio chart, equally weighted S&P 500, RSP symbol for the ETF, against the normal cap weighted S&P 500 symbol SPY. The ratio chart is the one that is in black and red. This has 20 years of data. When you go back and you look at 20 years of data, you can see that the ratio chart fell off of a cliff here in 2009 and again fell off of a cliff just after 2020. And the S&P 500, which is in blue, also fell off of a cliff with a 40% decline here in 2009, and here in blue fell off with a 19% drop. And look at how quickly, I mean, it was literally a cliff dive, straight down drop, okay? And at that point in time, the ratio chart, after it drops off of a cliff, travels sideways, and then it gets this. It gets that rebound. It gets that rebound right there. After the rebound, and you start looking at the ratio chart, after the rebound, and you look at the ratio chart, look at what happened to the cap-weighted S&P 500. This is after the rebound. On the ratio chart, you get a complete bull market in the S&P 500. You also get it for the equal weighted RSP S&P 500. Either market, you are traveling north and north with a vengeance. You can see our ratio chart is in this basic trading range between here and here. So we are still doing this bobbing back and forth. Let me clean this up. We are still doing this bobbing back and forth like we did here. We are still bobbing back and forth here. We do not have that leg or that leg right there. That leg is invisible to us. It has not appeared yet. When we get that leg up, that is going to be a for sure indicator that the S&P 500 and also the equally weighted S&P 500 are going to be, it appears that there is going to be a strong bull market once we get that. We don't have it. We watch this every single month. We give it to you guys every single month. And when that happens, we're going to be putting more leveraged dollars to work than non-leveraged dollars. Why? Because I think the risk is going to be there. The risk is, in my opinion, is going to be worth it at that point in time due to 20 years of history. So at that, and there's a certain way that I pyramid into the positions. It's not all or none and things like this. So there's still ways to protect yourself just in case the market doesn't cooperate. But in all intensive purposes, if that holds true and we get that long bull market like we did there and like we did there, those are going to be the absolute meal ticket years for the people who are following this strategy in order to make an unbelievable bankroll during that time. Now, I believe that we are going to experience a bear market between right now, March 1st, 2025, and when this line here appears on our ratio chart. I think the market is going to have a correction. The market had a 40% correction, it had a 20% correction, and it has not had that big, large drawdown yet with the ratio chart falling into the toilet. So I'm still waiting for that shoe to drop, so to speak. I'm waiting for that 20 to 25% or 20 to 35% drawdown in the S&P 500, and then things start to establish themselves and then head north. I really think that's going to happen. So I think we're a little ways away, like a few years before that line materializes on the ratio chart. We could be 2 to 3 years before we see that line. It's unknown. All I know is that the line is not in front of me today. So I'm going to be watching this, and I'm going to be keeping until I'm going to be a little cautious until I see the market either give me that pullback, that 20% pullback, or it gives me that line that comes up like that on the ratio chart. So I want to be really quick on the trigger to pull shares and pull equities out of this market and go to cash if needed, or whatever is needed in order to protect the portfolio. I want to keep my portfolio intact and then go in with heavier leverage after I see that line produce itself. Now we are looking at the VIX Volatility Index, or the Fear Index. Where are we at? We are in the low range, which is between this green line and this green line. So, and not only that, we were down here in the low area. And if you've been watching my videos, you saw I said, you know, I wouldn't be surprised to see it come up and at least tag this green line. It went and tagged this line. I had that, that line has been in place for a while. You can see the multiple tops that have produced that line, and we exactly tagged that exact line. And now it should theoretically be coming down like it has done in the past here, here, here. And when the VIX is traveling down like that, the S&P 500 is traveling north. Okay, so if the S&P 500 is going to come up here and travel north and somewhere come up here and tag that line right there, we're going to be long this entire time. We'll change our stance once we get up to there. We'll start putting more protective areas into our portfolio. Let's see what the market does right now. We absolutely need to hold that level on the S&P 500. If we start breaking down like this, well then this market is now making lower lows and it's just completely going off the reservation. Okay, now we are looking at a 3-year weekly candlestick chart for the S&P 500 with standard deviations. +2, -2 in gold, +1, -1 in pink, regression line in dashed green. I have a couple of alerts. On the low end, support. On the high end, resistance. You can see that we are traveling and trading right in between these two lines. I also have in here what I refer to as a valid trend line, taken from that low there to that low there. I have cycle brackets down here at the bottom with the majors and minors. Now, as an example, this low here is that low, and this low is that low. This minor low is right about there. So you can see that basically you've got, one cycle with 2 half cycles in between. Let me clean that up. But take all of the cycle brackets with a grain of salt, because the cycle brackets are just a drawing tool. Nothing is absolute. So what happened? It looks like we absolutely tagged this bottom valid trend line and started to come up off of it. We did not close below this valid trend line. That means that our long-term trend is intact, going north. Being longly, having our positions long is the way to go right now. Now, I want to switch over and I want to look at a daily. We're going to change this to 1-year daily, change our cycle brackets to 1-year daily. Now, with our standard deviations, +2, -2, -1, +1, you'll notice, look, going back 1 year, we only breached the -1 standard deviation for 1 day. And then the very next day closed above it, and then it didn't look back. We did not close below the -1 standard deviation. We came very close to it. If we go up, well, being longly positioned is going to take us right to our alerts. The first one to be hit at 621, the next one to be hit at 631. Bottom line is, if we start hitting 621 and then 631, I'm going to start taking leverage and off the table. Once we hit 621, I'm going to start taking leverage off the table. Once we get to 631, I'm going to start putting in steps to protect the portfolio against a downturn. Basically, as I see the market right now, that's the game plan. taking cycles into consideration, one thing I want to look at is I want to look at how do things play out. That cycle low looks like that one there. Then you have this one, and then you have this one. And I label these cycles. That one was positive. This one was neutral. The very next one was a negative cycle. Why is that? The reason why is because this cycle closed lower than when it opened the cycle. That is a negative cycle. Taking that cycle low into consideration right there. Then we came up, down, still higher than that cycle, came up, and now we did cross below this cycle here. So this minor cycle is a negatively configured cycle, this minor cycle. But taking this whole cycle into consideration, from this low to where we are at to where we went to, it's still positively configured. So if this holds right here, we are going to start traveling north from that point. So we are monitoring this. Looking down here at the MACD, you can see that on the histogram that we're starting to travel north, which would be good. Over here on the slow stochastics, you can see that if it's reached a going sideways action, and hopefully that's going to carry up and bring it to north. Okay, this here is an Excel spreadsheet that I created in an effort to get the health of various asset classes, which include equities, real estate, precious metals, bonds, emerging markets. And then down here is the 11 S&P 500 sectors broken down per sector. So trying to get an idea of how strong things look. What we do is we compare last week's reading to the week that we are at right now. So when it comes to asset classes, we are losing strength. We went from 57 down to 43. Now, we were in a yellow, and we are still in a yellow on asset classes. But what happened to the S&P 500 11 sectors? Last week, we were at 45. This week, we were at 56. What? I thought it was a negative week. Well, it was a negative week. But when I use this information, this is where I get the information from, how I fill in the chart right here if you want to do this on your own, okay? The market as a whole, the 11 sectors increased in strength. Not only that, once we get to the number 61 or greater, we're going to go from yellow to green. We are at 56. We are 5 percentage points away from a green signal. So if this market gets the bounce that I am looking for, it's going to take us from yellow to green. We're going to profit off of that. I believe that is what is going to happen with the S&P 500 in the next few weeks, maybe even next week, who knows, but let's give it a couple of weeks. We have the whole month. We know that there's a very high probability for the month of March. We're going to close higher than when we opened the month. So being positioned long is a good place to be right now. Okay, that is going to take us to the conclusion of this video. As of March 1st, 2025, the market summation, according to me, Ken, senior market analyst, your host for Conservative ETF Investor. The market is soft, as noted by the yellow on the strength signal right there. How do we want to play next week? I suspect sideways to up action for the next week. We are 92% in SPY shares. That means we're invested 92% with a 1 beta leverage, which we just have shares of the S&P 500. We also have 2%, only 2%, but still 2% in options, long calls, going long. And we have 7% in cash. I think we're positioned correctly with the information that is known to us at this time. If this market continues to travel north, I am going to buy some more long calls because I want to take advantage of a rising phase stock market. That is how I am going to be implementing my strategy in the short term. If you want to get my alerts and you want to receive them real time, you can sign up at this link right here. It will be down in the description down below. Over here is a chart for the S&P 500. Everyone gets the charts. Everyone can see where the market is and what the market is doing. Everyone interprets the information a little bit differently. That's why we all have different strategies, different styles, different techniques. There's a lot of different ways that you can make money in the market. This strategy that I am showing you is a strategy that I believe in, that I invest in to grow my own portfolio. I'm trying to share that information with you guys. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.